Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. May corn was not able to eclipse the previous high from early March, giving us a lower double top pattern as the market has recently been tracing down the 2x1 downside angle. Breaking back below the 1x1 angle, and now we can see a continuation pattern that suggests that the move into this continuation pattern would produce another move on the other side that would go down to potentially test somewhere in the neighborhood of 372 to 373 next week. That 372 number falls right along support previously from a couple weeks ago, and if the market were to break below this 372 number, we could see an even further decline happening shortly thereafterward. Part of the trouble that this May contract faced rests on the fact that the 180-degree mark at 392.25 was significant resistance. In fact, as the market had tested this level a number of times, we can see the market failed each time. And each time that it's dropped, we can see that it's fallen about the same distance on the way down. So it remains to be seen whether or not this market will once again fall down to about 373. If the market does close below this 381 mark that we've looked at quite a bit in the past, it's suggesting that this continuation pattern should repeat itself on the other side. And upon breaking 382, we can see an even further decline that follows through on the forward contracts. The December contract was actually able to make a new high, unlike its May counterpart. But what we're also noticing is that resistance at 417 was very strong, in conjunction with meeting our time factor of April 8th. Once the market moved up into this time horizon, we can see that time and price came together to produce what we consider to be a significant square out, and the market moved down to its point of control number just below, sitting at 405. If this 405 number is broken this week, given that we only have a day or two left, we believe again that the market will retest previous lows that sit at the next point of control number of 395 for this contract. One of the key factors that helped us understand that resistance could very well be strong was that this market did come in and form a S4 resistance level right above its point of control, and you can see the next point of control number just below is where support lives. Given the fact that it did come up to meet volatility-based support, which was just shy of our 180-degree mark at 419, this market is moving in conjunction with expectations. The next key downside support lives at 399. And if the market once again finds some weakness this week as it rolls into a close, we would not be surprised to see this market continue to roll down at least to the end of the month, which is where our next important time factor does rest. The theme of weakness was persistent for soybean as well, and we can see where the market came up to our 360-degree mark, which is typically where key rotations happen in markets in terms of reaching the full rotation termination level. Over at 1080, the market found very good resistance, barely getting very close to it, and really rolling over very close to its point of control number at 1071. So the market made its way up to 1071, barely closed above it, and we can see where the market reached up to about the 1079 mark, and again rolled back down over the last 5 to 7 trading days. Currently, we're finding support near 1048 3/4, but really at this 270-degree mark, or this point of control number that sits over at 1043, we can see that upon breaking this level that the market could very well come down and make a full 90-degree rotation, coming back down to test 1015. So the key level that we'd be looking for this week is to see whether or not this market's able to stay or to close above the 1042 to 1043 number. If it's not able to do so, we would anticipate continued weakness for soybean as well. Interestingly enough, on its way up, the market did find very good resistance up against the 1x1 angle, and each time it made a pass at this number, we can see that the market did respond very violently on the way back down. And so it remains to be seen whether or not this upside 1x1 angle will continue to be the key resistance for this market. But for now, we're looking for potential support on the downside. And the numbers that we're looking at that are going to be key for this week, once again, is that 1042 to 1043 mark. As was the case for the corn contract, the nearby contract was weaker than the forward contracts. Here we can see with the November beans that it too has now posted a higher high from the previous March and February highs when it broke up into the 1052 mark. Now, we've long been sharing with you how important it was for this contract in particular to close above 1052 quarter if it was to make it up to 1070 and possibly as high as 1100, where we were looking for this market to make its move. One of the key components that traders often ignore is the component of time, leaving all of their focus simply on price action. Price action, mind you, is very important, but if we run out of time for it to hit our levels, that also is part of the calculation or part of the metric that we look at to determine whether or not we've overspent our stay, and in doing so, to make the appropriate adjustments from what the market is communicating to us. 1052 quarter, again, was a very, very important mark for this contract, and the fact that it's having so much trouble getting beyond this level suggests that potential weakness may be on the horizon, although we're finding decent support inside of 1038 to 1039. So given that this market right now is trading inside of this key zone, perhaps next week we find a little bit of weakness that comes down to about 1028, but if 1028 is in fact able to hold, and then the market from there is able to make one more run to the upside and finally close above this 1052 quarter number, we would look for a minimum price objective of 1069 with the potential of reaching 1100 down the road. On the other hand, if we were to break 1028 next week, we do believe that a run to the upside could be exhausted for soybean, and we would be looking for key protection against downside movement. From this view, we can see where the soybean contract did meet up against volatility-based resistance, and once again, our very important 360-degree mark, and for this contract it happened to land at 1049, was also very important for November beans. The market now looks to be making its way down potentially, but on the other hand, depending on the way in which it resolves itself out of this pattern, we could see a breakout to the upside that gives us a nice move. So again, what we're looking for is the way in which this market trades for the balance of this week and going into next week. If it's able to hold key support, then we simply have a flag or a pennant formation happening right now. And if this market is then able to break back out to the upside, we do have one more push potentially that goes up to test that 1080 to 1100 mark that we've been discussing in the past. So again, we're looking for the market to make its close above that 1052 quarter number that's so important for this contract. Wheat futures is moving very much in conjunction with our cycle projections. We can see where the market made a bit of a consolidation across the bottom and then was able to make a nice breakout to the upside. And now we're seeing that it's now made a higher low. And if you recall from previous discussions, this is exactly the formation that we were looking for that was going to help us determine whether or not the market had a very good chance of moving to the upside. Support did come in right up against our 1x1 angle, and as long as we close above this 484.5 number this week, we do believe that potential strength could be on hand for wheat futures. Notice how we found resistance today right up against our 1x1 angle, and most importantly at the end of the week, if we were to close above this 491 number, then we do believe that continued strength to the upside is possible for wheat in the near term, where we're looking for a breakout with a very nice move that tests somewhere in the neighborhood of 540 to 550 before this contract comes off the board. The support that we found this week happened to overlay right on top of our 180-degree mark at 479 3/4. And so again, we do like very much the way in which this market is moving, finding support up against our key levels. Here we have it sitting also right on top of one of our point of control numbers after that consolidation that hit. And again, it's expected that after having reached volatility-based resistance for about 5 to 7 trading days thereafter, that the market would reverse or at the very least move sideways. So it's very nice the way in which it's found support up against our 180-degree mark, which suggests that the market then can make its now next move up to test first this 524 3/4 number prior to being able to make its way a little bit higher, if that is in fact in the cards for wheat. There is not much to share about the US dollar as it continues to trade in a consolidation that has been sideways between 89 and 91 for quite some time. And until it breaks out of this consolidation area, we do not anticipate a big move on either side, but simply for it to rest inside of this movement that we've been seeing. One of the key factors that we've noticed for the US dollar is currently overseas with the Italian government and the recent developments that we've seen there. The new government that has been trying to form itself, or at least that has been democratically elected, is finding trouble setting roots and being able to establish itself. One of the key criteria that's keeping it from being able to establish itself is the fact that it is anti-EU or anti-European Union. And so some of the forces that control the European Union obviously are not in favor of such a move. And so in doing so, we're seeing some political wrangling keeping things from being able to move forward. The way in which things resolve themselves are going to be key, given that the euro is such a large component of the basket of currencies that are measured against the US dollar. Depending on the way in which things fall out, could tell us or could show us the direction in which the dollar would look to go there afterward. A larger scale picture of a weekly chart again really shows us how sideways this market has been over the last several weeks. And the formation that we're also seeing also does suggest that the way in which this market is curving looks like it's predisposed to perhaps finding resolution to the downside. But again, we want to wait and see what the market does as opposed to trying to forecast in advance. But as we look at the chart formation, it does give us clues as to what direction it may want to take. Thank you so much for joining us for our regular market update. Look forward to touching base with you again next time.